Welcome to the DNR Capital Monthly Investment Review for May. My name is Mark Sidowi and with me is our Chief Investment Officer, Jamie Nicol. This month we discuss the implications of the soft consumer, housing concerns, the banking sell-off and the Australian dollar. We saw global markets perform well. We had the US S&P index reach all-time highs. Japan and Europe also performed well. However, disappointingly, the Australian market underperformed. This was really dragged down by the banking sector, which we'll discuss later. All of the Australian equity portfolios outperformed the market. I'll now hand you over to Jamie.
The market pulled back in May following a strong run over the past year. We've certainly been talking about an expected pullback, so it really hasn't come as too much of a surprise. This month we're going to examine a range of issues, including the implications of a soft domestic consumer, the housing concerns that are raising their heads once again, the fact that banks have been sold off, they're down about 10% over the past month, and whether it's time to buy, looking at the lead indicators from offshore and what it means for the Aussie dollar's perspective. Now, consumer's been pretty soft. We've seen a host of downgrades from major retailers like Retail Super Retail, AP Eagers, The Reject Shop. We've also seen a range of companies go under, such as Topshop Australia and Pumpkin Patch. And really the retailers the consumers reeling from higher mortgage costs, higher electricity, higher insurance costs. Yet despite this, there's really mixed signals out there. Retail sales were still up 3% in April for the year. Cafes and food retail was doing pretty well. We saw a bounce back in car sales in May. And business confidence is actually pretty strong. So some very mixed signals. But what we do think it highlights is that the consumer's a little bit vulnerable to higher interest rates. Now moving on to slide 5, we highlight these housing concerns. Australia is a country with very high levels of household debt. We've also had a booming house market across the East Coast. And the regulators trying to make sure that banks tighten their lending, particularly to investors and interest-only lenders. And this is causing interest costs to rise and creating a bit of a credit squeeze in that sector of the market. The issue is that this could spill over into slower construction, or likely to spill over into slower construction and potentially house price falls. What we do highlight is that we think unemployment is particularly important, as people will tend to try to repay their home loan, hang on to their house. They may not buy a new jacket, go on an overseas holiday, but they will try to repay their house so long as they've got a job. So whether those lower retail sales feed into lower jobs, lower construction feeds into lower jobs, whether those factors really put a constraint on employment levels, well, that'll be very important in terms of the level of softness likely to be experienced in housing. One of the things we're thinking about is what impact that has on the banks, and I'll talk about that in the next slide. So the banks fell about 8% in May, adjusting for the dividend. There's a number of factors impacted the banks. Firstly, the starting point was high. The banks started at the beginning of March, were trading at about 14.3 times earnings, which is at the top of their sort of trading range. Secondly, the bank levy came along. That cost them about 3 to 4%. I was expecting them to pass that on. I'm not sure it's so easy now. They look to pass on extra capital constraints over the last couple of years, but they've really competed that away. And we have seen non-bank lenders come into their space. We're seeing mortgage brokers compete. So they might be a little bit more tentative to pass those on from a mortgage perspective. Where we do think they might potentially move is on a more aggressive cost out program, which could get interesting. The Westpac profit result also highlighted that the banks are sitting on a large amount of interest-only loans. 50% of Westpac's book is interest-only. And with bad debts at cyclical lows, and with that consumer softness, it just highlights some concerns. Bad debts are at a low. If bad debts move to a sort of a cyclical average, then that's a further 5% weight on the major banks' earnings, probably about 10% to ANZ. So if you add the bank levy of 3 to 4, plus around the 5% from bad debts moving to the mid-cycle averages, really that accounts for the move in the banks over the past month. And there is again a bit of further potential for further capital to be raised, and we'd like to get an outcome by the end of this month. certainly the banks are getting more interesting, and I'd really get interested if we start to see a much more aggressive program of cost out. But I just think it's with these risks sort of elevated at the moment, it's too early to start buying, and we're underweight, likely to stay that way for the time being. So despite some of that doom and gloom that's visiting the domestic Australian economy, the offshore economy looks pretty good. As you can see on slide 7, the US business confidence is strong, as is Eurozone business confidence. Unemployment rates very low in the US. New orders are strong. Q1 earnings were strong. So we're still seeing some health in that particular economy. And then if we look at the Aussie dollar, you'd have to say that looks vulnerable. If our economy is looking softer, the global economy looking stronger, well then you see these interest rate differential between Australia and offshore start to close out. In the past, Australian dollar was really bid up. If you look on the chart on the bottom left, our interest rate was sort of near 5% back in June 2011, whereas the US Fed rate was close to 0, whereas that's starting to shift, and by the end of this year, the Fed rate could even be above the Australian rate. Similarly, we're seeing the difference in the long bonds, the 10-year bonds between Australia and the US get close to 0 now. So this is important because a lot of people have been putting capital in Australia to get the higher yield, the higher interest rates. If that's no longer on offer, that capital can flow out and we can see some weakness in the Aussie dollar, so a key thing to watch. Now, we think we're quite well positioned for these trends. We're underweight banks, underweight consumer stocks. The strength in the global economy, which is driving bonds up, means we're underweight some of the bond proxies like property trusts and utilities and telecommunication. And then we're overweight some of the offshore exposed names. About 50% of the portfolio has some exposure to offshore earnings. Stocks like ALS and Henderson Group and Seek and Treasury Wines, etc. So we do have a lot of really great companies that are operating in economies that are doing well, earning offshore earnings. They look pretty well placed to do well as these economies shift.
We've purchased Rio Tinto for the high conviction and SRI portfolios. Following a bounce in the resource last year, we've seen Rio underperform. We've seen commodity prices come off and some particularly big falls in the iron ore price. So buying into Rio Tinto after falling iron ore price made a bit more of the valuation appealing. So when we purchased Rio, it was applying an iron ore price of $40 per tonne, and the iron ore price is currently trading around $60. So we like the management team. They're a quality miner, they've got tier 1 assets, and they operate at the bottom end of the cost curve. We like the management team, and they're undergoing capital management, and we think the stock price can outperform. Thank you. This concludes the DNR Capital Monthly Investment Review for May.